All right, good evening, everyone. Welcome to this evening's class. My name is Leroy Phillips, and I will be your presenter. This evening, we're doing market geometry. Okay, is everyone with me? If you're with me, just give me a yes in the chat box. Wonderful, wonderful. All right, I see some responses coming in. Wonderful, wonderful. All right, so basically, market geometry is price projections in the market using measured moves. All right, now let's have a look at our disclaimer. Remember, everything we do here is for educational purposes. We are not financial advisors. Make sure you read our disclaimer. We also have our terms and conditions and disclaimers available on the Unit of Prosperity website. All right, so let's move into market geometry. It's a very simple topic, very simple. I believe it's very straightforward, and I think it would be something that you guys would find very interesting. All right, so I'll just let you know a little bit about market geometry and how I came about using it. Basically, market geometry is a trading methodology that I developed. It was inspired by the AB equals CD pattern. That's where the AB and CD legs of the pattern are equal in length. It was also inspired by the Elliot wave theories, impulse wave. That's where we have wave 5 typically being the same length as wave 1. Okay, so it basically helped me to create this methodology, right? So I discovered that measured moves appeared on the impulsive side of the wave. So in every, let's say, a 3-wave pattern or a 5-wave pattern, we will find measured moves inside of these types of patterns. And typically we find them on the impulsive side. So if we have a corrective formation, we will still find measured moves inside of them. And they're actually more common inside of corrective formations. And you would find that the market moves in a very corrective way most of the time. Okay, so finding measured moves would be very common. All right. Okay, so what we do is use these measured moves to project profit targets. Okay, so the market is very fractal in nature. We have similar patterns repeating themselves over and over again. So we simply use these pattern formations, and by using measured moves, by measuring one leg of the pattern, we are able to project the next impulsive or corrective impulsive leg of that pattern. Okay. Now, we can quickly determine if price is moving impulsively or correctively based on the construction of the measured move. So if the measured move is following the Elliott wave rules and guidelines, then it means that we're having a impulse, which is a 5-wave impulse. So we could be having a 5-wave impulse. We could also be having a corrective impulsive wave. That's where it can be 3 waves, or it can also be 5 waves, but there could be violations within the wave count. So typically, if it's going to be a 5-wave impulsive move, then we would notice that that pattern develops into a bigger degree 5-wave impulse. Or it could also be an ABC pattern, or it can also be AB equals CD, which is still a corrective formation. Okay, so let's have a look at basically our chart and see if we can find ourselves some of these AB equals CD patterns or ABC patterns or even 5-wave impulse moves. Okay, we can also find measured moves in WXY formations. We can find them. We can find them in uh, flat patterns. We can find them in almost every wave pattern that exists currently. Okay. In some cases, it may be a bit, it may vary a bit. For example, like in the triangle pattern, you can't really look at measured moves inside of the triangle correction, but you can use measured moves on the impulsive side, which is the impulse move that came before the triangle. We can use that measurement to project the next impulsive move that comes after the triangle. Okay, so let's go to our chart and someone pick an instrument. So someone pick an instrument and we'll go take a look at that. Okay, I see Kevin says XAU. All right, let's go. Okay, so gold. Okay, I see Bella is saying Elliot and Fibonacci. Okay, sorry, Bella. Sorry, Bella. Okay. All right, so we're here on gold and we're looking for measured moves, right? So we could start with the current price action that we have. Right now, if you look at this, let me just try to make it a bit bigger. I think this way it should be clearer to everyone. All right, so here we have 1, 2, 3, right? And what pattern would you guys consider this to be? Would you consider this to be a AB C pattern, or would you consider this to be AB equals CD? Right, let me just try to circle it for you. Right, what would you consider this pattern to be? Would you, okay, Kevin says ABC. Anyone else? Would you call this WXY? What would you call it? Kimberly says ABC as well. Okay, so let's go with ABC, right? So I would consider this pattern to be an ABC pattern. So you guys are correct. And why would I call it an ABC pattern? I would call it an ABC pattern simply because wave A and wave C are not equal in length. Okay, and if you look at the way this wave is constructed, in this case, if I go to, let's say, the 15-minute time frame, let's go back a bit, you can see that this is also, this is 1, 2, 3 here. Okay, and this, okay, this is still 1, 2, 3, just like this bigger formation, 1, 2, 3. So we have a flat pattern inside here, which I can label as WXY, right? So I have a flat pattern inside here. And you guys know how we label flat pattern formations, right? I like to draw these horizontal lines on the high and the low of the flat pattern formation, typically just to outline the nature of the flat pattern, okay? So you get price moving to the downside. So we look at this strong move as the pulse, which we refer to as the impulsive move. We look at the pullback. Once we get the pullback, this area will become the low. And once this low is established, if price pulls back and retest the low, now we have this confirming as the high. Okay, so we have the first low, we have the first high, we have the retest of the low. So now all we're missing is one more wave to the upside. Once we get the next wave to the upside, we will expect this A wave to come again to create the C wave. Now, if we use measured moves by measuring the A wave and projecting that measurement over at the end of the three-wave correction, we can have an idea where the C wave will end, right? So we can set our profit target to the length of the A wave to project our profit target for the C wave. Okay? You guys have that clear so far? Are you guys clear so far? Any questions? Anything you're not too clear on? It's very simple. It's a very simple technique. And I find that this is a technique that a lot of traders just don't understand. Like, they just don't get that the market is fractal in nature. It is not something that is overly complicated. It is very simple. It is just the same pattern repeating itself over and over and over again in similar ways. So the more patterns you understand, the easier it will become to be able to make price projections, make targets, make forecasts, right? So this is a three-wave move. If we would like to look at this corrective formation, right? The corrective formation is also a three-wave move, but the bigger formation is an ABC move, which we can label using these tools from TradingView. We have an ABC tool. We can label this A, this is B, and this is C down here, right? Now, if you look inside of the A, you will see that it is three waves. Because it is three waves, I look at it as a corrective move. So this three-wave impulse, it is a strong move down, so we will consider it to be a corrective impulsive move. So it is an impulsive move, but it is a corrective impulsive move, which means that when this pattern formation completes itself, the price will go against it, right? So I'm going to expect the price to go against it. Worst case scenario is that we can get another three-wave corrective move that looks something like this, right? Like that ends with a measured move like this, wave A and wave C being equal in length, and then the price goes down for another three-wave move like that, making this a bigger corrective formation. Okay, notice that we're still looking at three-wave moves being put together to create a bigger pattern. Okay, so let's go back. Now, after this three-wave corrective move, and we were able to identify this move as being corrective because we can just simply just look at this and see that it's three waves. Let me just move this out of the way. 1 second. Let me just move this out of the way. You can just look at this and see that it's corrective. You can see this is 1, 2, 3. This is 1, 2, 3 here. And this is, this looks like 1, 2, 3, 4, 5. Okay, this is, let's see, 1, 2, 3, 4, 5. No, this is 1, 2, 3, X, 1, 2, 3, right? So this is a double correction in this area here, right? But most traders won't be able to identify this unless you have a very good understanding of how price action is constructed, right? So this is 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3, right? So you have 3, 3, 3 here, and you have 3 here, you have 3 here. Now, if you take this to the lower degrees, I mean, gold is a bit messy. Like when you go to the lower time frames, you will see most of the gold candles look like this, very spiky looking candles, right? So gold is an instrument that you'd want to trade on the higher time frames, like maybe 1 hour and up. Okay, So I'm only bringing it down to the 15-minute time frame just so you guys can see some of the bigger waves a bit clearer. But the smaller waves are going to look very messy like this. Okay, they're going to look very messy like that. So now we have price moving back to the upside, right? And remember I said that after this 1, 2, 3, we can expect price to continue moving up, or we can expect a corrective formation, right? So this goes here like that. This is an ABC, all right? Now we can expect a 1, 2, 3, and down, right? We can expect a move like that. And what are we getting here? If I measure this move, let me just take this off. If I measure this, this is my first impulse. This is a strong wave to the upside. And if I look at this carefully, I can see that this is 1, 2, 3, 4, potentially 5 waves, right? So this is potentially 5 waves here. 1, 2, 3, 4, 5. Yeah, this is a very small wave. So this is potentially 5 waves up. And I measured that move. This is the measurement. And I need to project that move at the end of the corrective formation, right? So if we're going down 1, this is 2, this is 3, right? So this is going to be labeled, let's use WXYZ. So this is WXY, and this is X, and this is Z right here. Okay, so this is 1, 2, 3, 4, 5, right? So this is a 5-wave corrective formation, right? So if you understand the WXYXZ formation, you will be able to understand when this formation will complete itself. You can use trend lines as well to help you. If you pull a trend line like this, right? If you pull a trend line like this across the highs, it will make things a little bit clearer. You take that same trend line, you copy it, and you put it across the bottom, right? And as you can see, it contains the price. So once the price is contained within this sloping channel, this gives you an idea that the pattern formation is being formed inside of this. And this looks a little bit more like a flat type pattern. It's also referred to as a flag formation. It's a bullish flag. And we would look at this and call this a B wave. Okay. Now we take this same projection of the A wave and we project it at the end of the B wave like this. And as you can see, if we had set our profit projection to this level, we would be able to get out at the right time. Okay, so we would be able to get out with our profit. And what are we going to expect to come next? We will expect this wave to repeat itself at the end of this move, right? That is what we're going to expect. Okay, so it doesn't have to come exactly like this. Well, this is the first wave down. It doesn't have to have this exact same shape. It could take on a shape of its own, okay? But it will most likely be that exact length, all right? So all we need to do is wait for the wave, this wave up to complete itself. We are aiming for the measured move. Once we get to the measured move, we are out of the trade and we're waiting for the price to give us an indication that it wants to go down, okay? Now, it gave us a 3-wave move up. So this is 1, 2, 3. And this is also a wave that we could consider to be A, B, C, because we have a long wave, correction, short wave. This short wave is a wave that we refer to as a truncated wave. And we'll get into truncated waves as we go along. Okay. So upon this correction completing itself, we have 1, 2, 3. We can see that price pulled back. Once the price pulls back and violates the area of wave 1, we know for sure that this is a 1, 2, 3 wave corrective move. right? Because wave 4 should not violate the price area of wave 1 based on the Elliott wave theory. So now that gives us an idea that we can expect the price to go down. Now, since it's going down correctively, it is a bit difficult to know what exact formation is going to come. So we need to allow the price to give us some sort of signal. Okay. Now, with us getting 1, 2, 3 down, if we use market geometry, we measure the first wave, we project it at the end of the correction. As you can see, this is the exact same length, right? So we used the measurement of the first wave down, this first strong move down. After the correction, we projected that wave and we know where that wave is going to end. Okay. Once this 3-wave move ends, we're looking for some sort of indication that this move is going to continue down. So if it ended here and it went like this, flat like that, without violating the price area of wave 1, and we got one more push down, that would tell us that this is a 1, 2, 3, 4, 5-wave impulse. And if we got a 5-wave impulse, we will then expect this bigger correction like this, with this next wave to come to the downside, right? To complete this C leg of this A, B, C correction, or we can label it as WXY as well, okay? So that type of move did not happen. So what are we going to expect? The price came back, violated the price area of wave 1. Once it comes back and violates the price area of wave 1, we know that potentially what we're going to get is a flat pattern formation, right? So if we understand our patterns, we will know what we can expect, and we can project and set up for a flat like this, okay? Now, if we set up for a flat pattern like this, we will let this wave complete. The wave, the pullback to the upside, we let that complete. Once it hits the high, we are now looking for that sell setup, okay? Because as you can see, this is 1, 2, 3. This is to the downside. We need another wave like this, right? We already violated the price area of wave 1. So this is some sort of flat pattern correction that will take us to the downside, giving us that measured move, right? So I'll just use this. I'll place this here like that, and we will see if we get to that measured move, all right? But this time, it's not going down with A, B, C. It's going down as an expanded flat formation. This is where price comes down, makes a low, goes back, breaks the high, then comes down and breaks the low. Okay, breaks this low. All right, and as you can see here, came back, broke the high, came back, broke the low. But did we get to this level? Let us see. And we did get to that level. So this would be our profit target right at this measured move. So with us getting our profit target at this measured move, let us see what more is going on here. So this wave extended itself a bit longer. Now, as you know, this is coming down as a 3-wave corrective formation. These waves can take on various formations. If this is coming down 1, 2, 3, that's our flat pattern formation that's coming here. This wave could be longer because if this is A, B, and C, this C wave could be longer than the A wave. Okay, as you can see in this case, A, B, C, C is longer than A. Now, some patterns, some instruments, I should say, tend to have different types of patterns. For example, gold may favor the ABC pattern where you have a short wave and a long wave. It could be the A wave being short and the C wave being long. It could be the C wave being short and the A wave being long. Okay, so gold may be more of an instrument that would give us a shorter A wave or a shorter C wave, and the other wave is long to create ABC formations. In this case, we're having a bigger ABC formation. This one looks like it's even evolving a bit, extending itself. So here we can see it's coming down 1, 2, 3, 4, 5, right? So this one is coming down in 5 waves. Now, since it came down in 5 waves, remember this is 1, 2, 3. Remember, we do have pattern formations that can come 3, 3, 5. Okay? So this is coming down 3, 3, and 5. Now, since it's coming down 3, 3, 5, this wave would have been our profit target. So we would have taken profit around this level. So we can exit that. We can take that off, sorry, because the wave pattern evolved and became a bigger formation. And since it came down in 5 waves, at the end of wave 5, we expect that pattern formation to be complete. And since we're setting up over here, as you can see, this is a pulse to the upside. This is 1, 2, 3, right? Now, this type of formation that we're looking at, this one is sharp. This one is more sharp. This one is a bit more sloped. So this could be 1, 2, and 3 like this, right? So this is 1, 2, 3. So the end of that correction could be here, and we get that next move to the upside like this. Measure this move, project it at the end of the correction, and we can get this move back to the upside. Now, with us getting this move back to the upside, we can still see price come back to the downside. Because if this is 1, 2, 3, 4, 5, this is A, B, C, and we could get price still extending to the downside. But I would more want to favor upside in this case. Now, let's go to a higher time frame and see why I would want to favor upside. The reason why I would want to favor upside is, let me see here. This looks like a 3-wave move to the upside. And we are also getting a 3-wave move to the downside, right? So we're getting a 3-wave move down. If I use market geometry, look at this. I measure this first wave. This is 1, 2, 3, and I project this over here. Look at that. See this? We got the exact price projection. Once we hit that measurement, price went back to the upside because this is a corrective formation. I can label this ABC. I can label this WXY if I like. Okay, so I'll label this ABC like this. So we got 1, 2, 3, 1, 2, 3, 1, 2, 3 in this case, right? So we got 1, 2, 3 correction inside here and another move down. So this is 1, 2, 3. Now WXY is labeled 3, 3, 3. Okay, so this could be labeled 3, 3, 3. But I look at corrective formations that are built off 3 waves, and I label almost all of them WXY simply because I like using the WXY tool. The labeling of the 3-wave formations are more to help you understand how they are constructed. Okay, so it's good to understand how they are constructed, right? The labeling is not very important. It's the understanding of the concept that is important. Okay, understanding how these waves are built, that is what's important. So if this is 3 waves down and this is 3 waves up, then I would expect this to be a flat pattern formation, right? I would expect that to be a flat pattern formation like this. So this would be an expanded flat pattern formation. This is where we break the high and we break the low. Okay, and since we broke the low, I'll expect price to start making its move back to the upside. All right. Now, in this case, if I had to measure this first wave and project this, I would project it like this. And this would have been my profit target right here. Okay, so this area right here would have been my profit target if I was using market geometry in a case like this. Now, I'm using market geometry, projecting this bigger wave, but I can also now come and use market geometry on the first wave of the big move down, projected at the end of the correction. And as you can see, I get a similar profit target right here. Okay. So this way I can enter after this correction, take it down. I can also enter here, take it to the downside. I don't get to my profit target. I exit and I re-enter at the end of the correction. Go for another move down. Okay, I exit at this level. If the price continues moving down, no problem. I wait and I watch and I wait for it to reverse. Okay, because we are confident this is 3, 3, 3, which means we go back to the upside. Let's go to a higher time frame. Let me just remove these lines. All right, so I'll expect price to come back to the upside one more time. Let's remove that. I'll expect price to come back to the upside one more time. Now, let's do some more market geometry. Let's look at, let's see here. Look at this complex type corrective formation. Look at how complex this is. But if you understand the Elliott wave theory, you would be able to put this all together to understand where the correction will end. Okay? If you understand the Elliott wave theory, you can put this all together. So you can see this is a sharp move down, sharp move up, and here, this is where it goes corrective, right? So it goes corrective here. We get another sharp move up. This is this move repeating itself over here. We get another sharp move down. This is this move repeating itself over here. Okay? And that is just how pattern formations are built. We just need to understand its impulse, correction, impulse. But the correction can become very complex. So we need to be able to sit out of corrective formations. And one of the ways in which I use to sit out of corrective formations is with the knowledge of knowing that the flat pattern is very common. You can always create a horizontal line at the high. So when price is pulling back, you create a horizontal line at the high. Once you create a horizontal line at the high, the price pulls back. Once the price comes and retests that area, all you need to understand is, did it come down in 3 waves? Because if it came down in 3 waves, at the end of the 3-wave move, we can look to buy it back. And we buy it back to the high. When we get to the high, we will exit. Okay, we will exit the trade, because if it came down in 3 waves aggressively, which looks more like an impulsive move, and it goes back to the upside in 3 waves, we will expect that it will come down again, because price moves in 3 waves. So we expect 1, 2, and 3. Now, as it's coming down, if it continues to come down, hits the bottom, this is 1, 2, 3. We will look to buy it again. Okay, but now we need to understand the relationship between these waves. Okay, if this wave is 1, this one is 2, this one is 3, and this one is sloping like this, then we know that potentially what we're going to get after this correction is this wave. It's going to repeat itself. And as you can see, that wave did repeat itself. And now after this wave, we have 1, 2, 3, which will give us more of a B wave or more of an X wave type correction. Okay, now with us getting that, we know that this wave is a complex connector wave. After this connector wave, which is X, or we can label it as B, we will expect the next impulse down. So this wave we will project the distance of this wave at the end of the correction, and we can use this horizontal line to help us identify the end of the correction, since the correction is going flat. project that distance at the end, and we will look to take profit at the end of that corrective move. Since this is a correction, we know that we're looking for the next move to the upside. And we can simply go back, look at the previous impulse, take the measurement, and project it at the end of the correction like this, as you can see. And we can use this as our profit target as well. So the price is expected to go up. We use the impulsive move that came before the entire correction, project it at the end of the correction, and this is our profit target. Once price gets to our profit target, we are out of the trade. Out of the trade, looking for the next setup. Price will typically go into correction again for another move up or reverse. Okay, if price is going to reverse, we wait for a pulse down, correction, and that continuation to the downside. Okay. Any other instruments you guys would like us to look at? Let me see here. I see Bella is asking. Okay, before I go into Bella, I see Raheel is asking, can you say that again? Raheel, what are you asking me to repeat? I'm sorry, I got this a bit late. I saw your comment a bit late. I see Raheel says fib. What do you mean by fib? Are you referring to Fibonacci? Oh, okay. Raheel said I repeated it already. Okay. All right, let's go to Bella. Bella said, did you anticipate that? Bella, when you say, did I anticipate? When I place my measured move at the end of the correction, I am anticipating that price will move to the upside. Okay? Remember, if you understand the different corrective formations, you will know when the corrections should end. And when the corrections come to an end, all you need to look for is a signal that is going to move to the upside. And we will touch on other things that we will look for. For example, one of the things that we look for is a volume bar. Okay, now that volume bar, you see this green bar over here, right here, this green bar, this is a big volume bar, right? I know other traders use a volume indicator and all different things to determine volume. I don't really use indicators. One of the only indicators that I use is the relative strength index. Okay, I find it's the most effective indicator out there, right? But at the end of a correction, all I look for is, once I make my measured move, I look for a volume bar. Once I find myself a volume bar, that means that we have buyers coming into the market. So the correction has ended. The buyers are now coming into the market. So all I need to do is get in or wait for a correction to be able to get in. Okay? So this is the volume bar, wait for the correction, then get in at the end of the correction. So it's not always going to be very clear on the correction because of how choppy price can get. It could be a bit difficult, but one of the things that you can do is use trend lines. When you use trend lines can help you to find the breakout of a pattern formation, and you can trade it on the breakout. So typically when price breaks out of a pattern of a corrective formation, like let's say price is going sideways, either sloping down or going flat, you draw a trend line over it. Once the price breaks out over it, it means that that correction has come to an end. Okay, so that's traditional. That's a traditional way of looking at it. Okay. The more modern way of looking at it is the wave count. The wave count is not always very simple. So you can mix the two together, the traditional and the modern way of looking at it, which is using the Elliot wave theory, understanding the correction and so on. Okay, let's see here. Um, Bella says it was a different wave earlier. Um, it was when it surpassed your TP. How do you use the RSI? Okay, with the RSI, I like day trading more than swing trading. Okay. Now I will get into the RSI with you guys a little bit later on. That is another topic of its own. So it might be a bit much to get into this evening, but just to give you an idea, okay? Just to give you an idea, look at this. The price is trending up, okay? I am not looking for a sell setup. I'm looking for a buy setup. I need to find the complete pattern formation, and I need to find the end of that pattern formation, which is a corrective formation. I need that to end with the RSI in the oversold condition. Now, oversold is another term that is traditionally used. I just like saying in the lower extremes. Okay, so the lower extremes mean that price has reached its strength threshold. Okay, so the strength to the downside has come to an end. It's drying up once it gets to the lower extremes on the RSI. So if I see that wave is in the lower extreme, I get a volume bar out of that lower extreme. That gives me confidence that we are heading back to the upside. So it's a combination of the two that would give, of the three, I should say, that would give me, reasons to go long. Okay. As you can see here, we are in the lower extremes on the RSI right here. We are in the lower extremes. We did make our measured move. We got a volume bar. The only thing left to do is enter to go long. Okay. You enter and you wait. Now, if you are a day trader, you need to know when to get in. And to understand when to get into the market, you can go look at the class I did on sniper entries. Okay. So that you guys can go back and look at the class I did on sniper entries, which is where you pick the times that you want to get into the market. So you're looking at get into the market at the market open. You're looking at lunchtime, and you're looking at the open of the next session. So you need to understand when the sessions are opening and when the sessions are coming on a break, when they're closing, because all of these are important. Okay, you're trading. If you're trading currency pairs, you need to understand that you're looking at two different sessions and they're going to overlap. But typically, since most of us are trading on the Eastern Standard Time Zone, we may want to trade the London session. We may also want to trade the US session. Now, the London session and US session, these sessions make the best trade opportunities, right? So we look to get in at the start of the London session. So we look for a reason to get into a trade at the start of the London session. And typically we can see price just continue from that direction. If it switches and you're stopped out, you need to switch with it as well. Okay, because it just simply means it's going in the opposite direction. So you need to understand as well where to set your stops. And as I said, we'll go into that as well as we go along. We'll have a class on where to set stops, how to set stops, and so on. Okay, but this evening, we'll just try to focus more on the measured moves using market geometry, right? And as you can see, if we're using measured moves, it would help us to have very accurate price targets. Okay, so we got this move up. If I'm to measure this move, and I'll project it after this correction, you can see here that I got to my profit target as well. And with me getting to my profit target, as soon as I'm done, I'm out of the trade, you can see that we go into correction again. Okay, and if we go into correction again, I simply measure that move. And I can use that and project that into the future as well. And potentially this could be our next profit target. Okay. So it's nice to understand what we're looking at. If this is a flat pattern that we're looking at over here, like this, if this is a flat, let me just double check this. Okay. We did not come back and retest the low. We came very close to the low. So this is possibly a flat, or this could just be one, this is two, and this is our wave three that we're building. Okay, so if this is our wave three, and as you know, wave three is typically the longest wave. So if this is wave three to the upside, we will expect a wave four and a wave five to complete this move to the upside before we see a bigger correction down. Okay, so let's see here. What are we looking at? If I'm to try to just, all right, so this is one, this is two, 1, 2, 3, 4, 5. So this is wave three, this is wave four, this is wave five. Wave five and wave one are typically the same length, right? So I can expect this to be like that. Okay, so that's how we use market geometry. So if you understand what wave you're in, it will help you to get the best price projection so that you can set your targets the right way. Okay, so this wave would simply be labeled like this. 1, 2, 1, 2, 3, 4, 5. This is wave four, potentially, and this is wave five coming here, right? So we have 1, 2, 3, 4, 5. All right. Wave one, let me just change the color, make it a bit brighter for you. Wave one and wave five are typically the same length, right? So we can use the price projection of wave one to project wave five. Wave five can also be a truncated wave. Wave five could potentially also be an extended wave, but wave three already is an extended wave. So wave five will typically be the same length as wave one. Okay, so it's good to understand the Elliott wave theory. So this way we can use market geometry the right way. Okay, now this wave to the upside looks very corrective, impulsive. So even if it's going up in 5 waves, I would assume that this is most likely potentially a flat pattern formation. If it's not a flat pattern formation, or let me see here. Yes, if it's not a flat pattern formation, it is going to be a 5-wave move. And what can help me to identify if it's a 5-wave move or not? Let's drop this down a little bit. All right, so this is, okay, this looks pretty much like a 3-wave move to the upside. Okay, it's very messy, and so I'll look at it as a 3-wave move to the upside. So this is most likely not a impulse to the upside. This is most likely a flat formation, and this is going to be 1, 2, and this is wave 3, which is a 5-wave move. So I will expect one more push up on gold, which will be the measured move of wave 1, right? So one more push up on gold. Let's go 1 minute. All right. Here we can see the price has evolved. Price has come back, hit the low, with price coming back and hitting the low right before our eyes. As you can see, we didn't get that push up. It came back and hit the low, so I'll project it from the low. Right, we'll take this, put this over here at the bottom. And now we will project this to come back to the upside. I do not think that this was 1, 2, 3, all of the correction. No, I'm not. Let me see here. I don't think this was 1, 2, 3, all of the correction, and this is 1, 2, 3. It is possible that this could be 1, 2, 3, this is 1, 2, 3, but we will still come back to the upside, right? I'm still going to expect this one to come back here. After coming back to this level, it could go 1, let me just try to draw it in. It could come back like this, 1, 2, 3, like this, or it can do 4, 5, then drop. Okay, so we'll expect it to come back and maybe give us one more move to the downside. We would have to go back into that pattern construction and see what we're looking at here. All right, so this is 1, 2, 3, 4, 5, or this is 1, 2, 3, 4, 5. So one more push down is what we're going to look for before we move back to the upside. Right, so something, oops, we're going to look for one more push down. Right, one more push down. I'm not confident that this is all of the correction here and this is the move down. Not very confident about that. So we will see how it plays out, and based on how it plays out, we will make our decision. Okay, remember, you don't want to get into the market in situations where you're not clear as well. Okay, this one is making a very strong move down, so that means that this most likely was all of the correction. So if that was all of the correction, this is potentially 1, 2, 3, 4, and this is wave 5 coming here. So what I'm going to do is measure that wave, measure this wave right here, and I will project this over here from this level like that. Right, so I'll expect, let me try to get it as accurate as possible. I think I got it there. Good. Okay, so as you can see, I measured move. This one doesn't belong here anymore. This wave doesn't belong here anymore. And I'll expect price to start making its way back to the upside now. Okay, so from that level, I'll expect price to start making its way back to the upside. We will wait and watch because, as you know, price can evolve. Okay, it can evolve. So right now we just need to wait and watch. Let's see if we get a big volume bar, big green candle to the upside. If possible, a correction for more upside, and we will buy the breakout of that correction. So you don't need to just jump into the market. You need to make sure that you have some sort of sign that the price wants to go in your direction. On a lower time frame, we could potentially already be getting a green candle pushing back to the upside, because this wick could also be a green bar on a lower time frame. All right. But typically we like trading on the 1 hour time frame and up. So we're looking for a 1 hour signal to go long. All right. Let's see here. Kevin says for a high or low to be broken, does a candle body have to close above or below the high or low? No. A break is a break. It doesn't necessarily have to close above to be considered a break. Okay, once the price comes and breaks the level or is equal to the level, I look at it as a break or a retest. Okay. Let's see here. Can the wick alone break previous high or low, creating a new one? Yes, you're right. Once the wick breaks the level, it's broken. Is the high or low measured by the wick of the candle or body alone? When you measure a candle, you measure the entire candle, wick and body. Okay. If you're using market geometry, you need to measure wick and body, not wick, not body only. You need to measure wick and body. Okay. The wick is also part of the candle. All right. Any other questions, guys? All right, we have a close of that red bar. It did make that measured move. So we did find wave 1, the same length as wave 5. Okay, so we have 1, 2, 3, 4, 5. Right? So this is a flat pattern, remember? 1, 2, 3. It's a flat. A flat pattern can be 3, 3, 3, or 3, 3, 5. So now that we've completed 3, 3, 5 in this wave, we will expect this wave to be a complete formation and expect price to start moving up. Okay? If the price does not go up, it needs to go sideways, giving us an extension of the wave. Okay? And if it's going to go sideways, we'll expect something a bit bigger, like some sort of flat like this, and we continue moving down. So some sort of flat type corrective formation, and we make another move down, which will be this measured move, the entire wave. All right, we'd measure the entire wave and project the entire thing at the end of the correction like that. And this would be our profit target down here. Okay, but I'm not favoring that right now. What I'm looking for at the moment is more of a move back to the upside correction, continue to the upside to complete that wave up. Okay, so that's what I'm looking for. All right, let's see. Any questions, guys? Anything you're not too clear on? Everyone clear so far? No questions at all? I see Mark says amazing. Kevin says clear. Wonderful, wonderful. Trading can be easy. You just need to understand how these patterns are built. It is not always going to be clear as day. Market makers are not going to make it easy. Okay? So just take your time and understand the pattern formations. Once you understand the pattern formations, things will become easier as you go along. Okay? Do your best not to complicate it too much. Simplify as much as you can. Okay? Back in the days of Ralph Nelson Elliot, price action was a bit more clear. In today's world, it has evolved a little bit more. Okay? So you need to evolve with it. You don't have to set your mind in stone. You simply need to understand the concept. So what Ralph Nelson Elliot used to look at before and call a 5-wave impulse, in today's world, we will see a 5-wave move, but it will be built slightly different in some cases based on the instrument. Okay? It gets a bit complex at times. So keep your minds open. All right, keep your minds open. Understand where these 5-wave moves can come, and not because you see a 5-wave move, it means that price is going to the moon. No, it does not mean that. Okay, a 5-wave move could be part of a corrective structure. So you need to understand that when you see a 5-wave move, understand what that 5-wave move is part of. Okay. All right, guys. I'll leave you guys with this. I think we have met our 1 hour threshold. Don't want to make the recording too long. Thank you guys for your time. I hope I see you guys next time on our next class. You have yourselves a wonderful evening. Bye-bye for now. Kevin says gold session tomorrow. Oh, good session. Okay, okay. I thought you said gold session tomorrow. Your TY. Okay. Thank you, Kevin. Mark says thanks again. You're welcome, Mark. Yeah, you guys can look out for this move to the upside. This is potentially a very profitable move that is coming right now. So you guys can look out for that. Okay. Bye bye, guys. Good evening. Nolan said, thanks, good first lesson. You're most welcome, Nolan. Thank you so much for coming.